The basic forms of business organization. The basic forms of business organizations are sole proprietorship, partnership, and corporation. Let's initiate with sole proprietorship. This is a business owned by one individual and has multiple advantages and disadvantages. For the advantages, the number one is that requires no formal charter. Number two is that has minimal organization costs and profits and control are not shared with others. But there's disadvantages like limited ability to raise large sums of money or unlimited liability and limited life. Now let's continue with partnership. It's similar to sole proprietorship, but more than one owner. For the advantages is that it's minimal organization effort and costs and too few government regulations. But for the disadvantages, it's unlimited liability, limited ability to raise large sums of money, and 3. Dissolved upon the death or withdrawal of any of their partnerships. The limited partnership, one or more partners, some with limited liability up to their investment if business fails. In example, the real estate. The general partner manages the business. Limited partners not involved in daily activities and don't receive return in the form of income and capital gains, and often receive tax benefits. Corporation, also called a C corporation, a legal entity existing apart from its owners, stockholders. Ownership evidenced by possession of shares of stock, and has some advantages as well, like unlimited life, limited liability, transfer of ownership through stock transfer, and 4. Ability to raise large sums of capital, but also with the disadvantages. It's difficult and costly to establish, and subject to double taxation on earnings and dividends paid to stockholders. There's another subchapter of S corporation that is a form of corporation whose stockholders are taxed as partners, distributes its income directly to shareholders, avoids corporate income tax while enjoying the other advantages of the corporate form. However, unlike a partnership, shareholders cannot receive allocations disproportionate to their interest. To qualify as an S corporation, a corporation must do these 3 things. Have fewer than 75 shareholders. None may be non-resident alliance. Have only one class of stock. And properly elect subchapter S status. For the last one, we are gonna talk about Limited Liability Company, or LLC. Most states permit the establishment of LLCs. An LLC provides limited personal liability, as a corporation does. Owners, who are called members, can be other corporations. The members run the company unless they hire an outside management group. The LLC can choose whether to be taxed as a regular corporation or pass-through entity. Profits and losses can be split using special allocation rules that allow distributions disproportionate to members' interest.